Welcome, curious listener, to The Deep Dive. Ever tap that Uber app for a ride, or maybe get dinner delivered and just pause for a second and wonder, how does this huge global company, Uber, actually manage everything? All the moving parts, the money. It's got to be incredibly complex.
Oh, it absolutely is. A massive operation. That's exactly what we're going to try and unpack today. We're digging into Uber Technologies, Inc., specifically looking at their latest Form 10K annual report for 2024.
Right, the 10K. So for you listening, this isn't just some dry financial document. I mean, it is required by the SEC, but it's packed with info, right?
Exactly. It's like a blueprint. It shows their finances, sure,
Yeah.
but also their operations, their strategies, the challenges they see. It really gives you the inside track on how they think and where they're headed.
Okay. So our mission today for you, our listener, is to cut through all that detail and pull out the really important stuff. We want to look at how their different businesses are doing mobility, delivery, freight.
Yeah, and what's really driving those financial numbers we see, how are they trying to create value for their shareholders? And crucially, what are the big hurdles and opportunities they're facing?
The goal is to give you a clear, informed picture, without drowning you in jargon, get you up to speed quickly on this major tech player. Okay, let's get into it. So at its heart, Uber says it's a technology platform, right? Connecting point A to point B using its network tech operations.
That's their core identity. Leveraging this massive network they operate in over 70 countries, which is pretty staggering. U.S., Canada, Latin America, Europe, Middle East, Africa, Asia Pacific, basically everywhere except Russia, China, and Southeast Asia, where they've divested or sold stakes.
Being that global must give them some serious advantages, like data. But I imagine it also creates headaches.
Definitely both. The scale gives them incredible amounts of data for optimizing things like pricing and routes. That's a huge edge. But yeah, it also means juggling, dozens of different regulatory environments, local competition, customer habits. It's a constant balancing act.
And this global operation is split into those three main parts: mobility, delivery, and freight. Mobility is probably the one everyone knows best.
Yeah, that's the original Uber, ride sharing, obviously, but also things like car sharing, those scooters and bikes, micromobility rentals, even linking up with public transit and taxis in some places.
What do they see as their edge there, just being the biggest?
Well, size helps.
Yep.
They believe their global leadership and all that marketplace data lets them innovate faster. They aim for, better experiences for riders, more reliability, and better earning potential for drivers. Plus, they're adding layers like financial partnerships and advertising right into the mobility app now.
Interesting. So it's not just rides anymore. And then there's delivery. They really jumped into that space.
Oh yeah, Uber Eats is the main brand there. It started with restaurants, but now it's groceries, alcohol, convenience stores, other retail. They lump it all together as grocery and retail, and it's a huge strategic focus for them.
It seems to be working strategically, too. The report mentioned something like 61% of first-time delivery users in Q4 2024 were totally new to Uber.
That's right. It's a massive funnel for bringing new people onto the platform overall. And it gets better. People who use both rides and delivery, they take way more trips per month, like 11.4 trips versus just 5.2 for people using only one service.
Wow, so it really increases engagement. That's sticky.
Exactly. It deepens the connection. And like mobility, they're innovating here too. They've got Uber Direct, which is like a white label delivery service for businesses, and again, more advertising.
But the competition in delivery must be fierce. You've got DoorDash, Deliveroo, Instacart.
Oh, incredibly fierce. DoorDash, Deliveroo, Glovo, Instacart, GoPuff, Rappi, Delivery Hero. Even Amazon is in the mix, plus all the local players and restaurants doing their own thing. It's a real battleground.
Okay, and the third pillar is freight. Less familiar to most consumers, I'd guess.
Probably. This is about big logistics, connecting shippers, businesses needing to move goods with carriers, so trucking companies. The idea is to bring that Uber-style tech platform efficiency, like upfront pricing and easier booking, to the freight industry.
So trying to simplify a traditionally complex market.
Precisely. Using their tech to match loads with trucks more efficiently.
What's the common thread tying these three, pretty different businesses together?
It really comes down to their core technology and operational model. They emphasize their proprietary tech for marketplaces, routing, payments that underlies everything.
Ah, the platform idea again.
Exactly. That tech allows them to manage supply and demand across these diverse markets. Plus, their on-the-ground operational teams in different regions are key for launching services, dealing with local issues, and ensuring safety and trust, which is crucial everywhere.
And they plan to keep investing in this platform, building more on top of it.
Yeah, they explicitly state they'll keep investing in new offerings to strengthen the whole ecosystem. It makes sense. Leverage the core tech and network across more services.
Okay, fascinating how those pieces fit. But let's talk money. Because the financial story in 2024, wow, that net income jumped from what, under $2 billion in 2023 to nearly $10 billion in 2024?
Yeah, $1.887 billion to $9.856 billion. It's a huge number. And total revenue was up a solid 18% to almost $44 billion. Adjusted EBITDA also looked really strong, up 60% to about $6.5 billion.
So operations were definitely improving, but that net income leap, it can't just be from more rides and deliveries, can it? There must be something else going on there.
You nailed it. While the operational growth in mobility and delivery was definitely strong, that adjusted EBITDA jump shows the core business is generating more cash. The absolute game changer for the net income figure was this massive $5.8 billion income tax benefit.
A tax benefit, how does that work?
So think about all those years Uber was losing money while it was growing rapidly. They built up significant tax losses, what are called deferred tax assets, basically potential future tax savings. But accounting rules say you can't fully count on those savings unless you're pretty confident you'll actually be profitable enough in the future to use them.
Ah, okay.
For years, Uber had a valuation allowance against these assets, essentially saying, we're not sure we'll be profitable enough. But in 2024, they demonstrated sustained profitability, particularly in the U.S., so they could finally release that valuation allowance, about $6.4 billion of it.
Yeah.
That flowed straight to the bottom line as a non-cash benefit.
Wow. So it's not like they got a $6 billion check from the government, but they could finally recognize these past losses as valuable future assets on their books.
Exactly. It's a huge accounting event that signals a real maturation of the business model and confidence in future profitability. It dramatically boosted net income, even beyond the strong operational improvements.
That context is crucial. So operationally, how did the segments perform to get that adjusted EBITDA growth?
Mobility led the way in absolute dollars. Revenue up 26% to over $25 billion. Adjusted EBITDA up 31% to nearly $6.5 billion. Really strong.
Okay.
Delivery also showed great progress. Revenue up 13% to $13.75 billion. But its adjusted EBITDA soared 64% to almost $2.5 billion. That shows real leverage and improving margins in the delivery business.
So Deliverr is becoming much more profitable. What about freight?
Freight was the odd one out. Revenue actually dipped slightly, down 2% to $5.1 billion, and its adjusted EBITDA loss got a bit bigger, widening 16% to a loss of $74 million.
So still investing heavily there or facing headwinds?
Likely a combination. The freight market itself can be cyclical, and they're still probably investing to gain share and refine the model. It's clearly not contributing positively to profitability yet like the other two.
Got it. Now, costs naturally go up with growth. Cost of revenue increased by 19%. What drove that?
Yeah, that $4.2 billion increase came mainly from a few key areas. Insurance costs jumped by $1.3 billion, tied to more miles being driven in mobility and potentially higher rates per mile.
Makes sense. More driving, more insurance costs.
Right. And another $1.3 billion went to increased driver payments and incentives, again, reflecting that mobility growth. Courier payments for delivery were also up significantly by about $718 million. And things like credit card processing fees also rose. So direct costs tied to the volume of business.
Okay. And then there's that line, other income expense net. It looks stable overall, around $1.8 billion, but you mentioned some interesting things hiding in there.
Yeah, the total number didn't move much, but the components did. Interest income went up by $237 million because they were holding more cash and investments. But the big swing factor was unrealized gains on their investments.
Their stakes in other companies.
Exactly. They had huge paper gains in 2024. $723 million from their Grab investment, $629 million from Aurora, $357 million from Didi. These aren't cash yet, but they reflect positive market views of those companies.
That's substantial.
It is. On the flip side, they also booked a $236 million expense because their planned acquisition of Food Panda Taiwan got blocked by regulators. So lots of moving pieces within that other income line related to investments and one-off events.
And quickly, seasonality. Does that play a big role?
It does, and they flag it. Typically, Q4 is stronger for mobility and delivery, think holidays, more business travel. Q1 tends to be slower, post-holiday lull. They noted that their rapid growth has kind of masked this effect historically, but they expect it to become more noticeable now as growth rates start to moderate a bit.
Okay, so a financially transformative year in 2024, driven by both operations and that huge tax benefit. How are they translating this into value for shareholders, and what are the big clouds still hanging over them?
Well, on the shareholder value front, they got pretty active. Big news was the board authorizing a $7 billion share repurchase program in February 2024. That's a strong signal.
Buying back their own stock.
Exactly. It reduces the number of shares out there, which
Mhm.
tends to boost earnings per share and signals management thinks the stock is undervalued. They kicked it off quickly, too, completing a $1.5 billion accelerated share repurchase, or ASR, in early 2025.
Okay, that's direct return to shareholders. What about managing their debt?
They've been actively refinancing and reshaping their debt. In 2024, they paid back $4 billion of older debt, but also issued $4 billion in new debt. It wasn't just rolling it over, though. They paid off specific, likely higher-cost term loans.
Right.
And they issued $1.73 billion in low-interest convertible notes, 0.875% due 2028, using some of that money to pay down other debt. Plus, they set up a new $5 billion revolving credit facility, like a big credit card, for flexibility. So optimizing their debt structure seems key.
And there was something about buying back part of the freight business.
Yeah, they bought back $851 million worth of preferred stock in freight from an investor. This wasn't totally optional. The investor had the right to demand an IPO or have Uber buy them out, so Uber fulfilled that obligation, but it also gives them more control over freight's future.
Okay, so managing capital structure, returning some cash. But this is all happening against a backdrop of significant risks. That driver classification issue feels like it never goes away.
It really doesn't. It's probably the most fundamental risk to their model. They're facing legal battles all over the world: California, France, Spain, Mexico, Switzerland, arguing drivers should be employees, not independent contractors.
And if they lose those battles,
It could mean massive cost increases, wages, benefits, payroll taxes. It could totally change the economics and potentially reduce the pool of drivers if flexibility is lost.
yeah.
While they won around in Massachusetts, allowing contractor status there, the threat is global and persistent. Plus, you're seeing unionization efforts gaining traction, like in the UK, which adds another layer.
That's huge. What other regulatory hurdles are they constantly navigating?
Oh, it's a long list. Antitrust scrutiny is always there, questions about their pricing power, market dominance. Data privacy is massive, especially after past breaches like the one in 2016 that led to FTC settlements and fines. They have to deal with complex rules about moving data across borders, data residency laws.
Like in Egypt or Hong Kong, you mentioned?
Exactly. And then you have local rules popping up all the time, caps on delivery fees, limits on surge pricing. These can directly hit revenue and profitability in specific cities.
And environmental pressures, too, like EV mandates.
Absolutely. California's push for 90% electric vehicle miles by 2030 is a big one, requiring significant changes to the fleet on their platform. Congestion charges in cities like London also impact drivers of non-electric vehicles. These things can increase costs for Uber or their drivers, potentially affecting driver supply.
It's a minefield. So how does Uber frame its own path forward, balancing growth ambitions with all these challenges?
They're still focused on growth expanding, gaining market share, launching new products, trying to crack those less dense suburban and rural areas. But the 10K is pretty clear. They know they'll continue to have significant expenses.
So the key is?
The key is growing revenue faster than expenses. That's the mantra for sustained profitability. And achieving that depends heavily on navigating all those competitive pressures and regulatory hurdles effectively across dozens of countries. It's not just about getting bigger, it's about getting smarter and more efficient.
So to wrap up for you, our listener, we've seen Uber have this really significant 2024, a major turnaround in net income, boosted hugely by that tax benefit, but also solid growth in mobility and delivery profitability. They're actively managing debt, buying back shares.
But yeah, they're operating in this incredibly complex environment. The fight over driver classification is fundamental and ongoing. Regulatory pressures are constant and evolving, from data privacy to environmental rules. Competition remains intense across all segments.
Which leaves us with a final thought for you to mull over. Uber's shown it can achieve profitability and scale. But looking ahead, how will these persistent regulatory battles, especially around the nature of gig work and the pressures of sustainability, truly shape its future? Can technology and operational efficiency keep outpacing these fundamental challenges?
It's really the core question, isn't it? How will Uber's own evolution, driven by innovation and its responses to these pressures, ultimately redefine not just its own business, but maybe also the future of work and how our cities function?
Something to think about the next time you need a ride or order in.